As I mentioned earlier, we are very delighted to have two speakers from other agencies with us today. Our second speaker from another agency is Mr. Mark Moses. Mark is the Director of Finance Services for Regional Government Services Authority, commonly known as RGS, where he has served since 2013, providing interim financial management and consulting services to cities and special districts, including his current role as Finance Director of the City of San Rafael. Mark began his career in banking and small business consulting before turning to financial management for cities and special districts. Please help me welcome Mark. Thank you.
All right. I don't know what I did to deserve the after lunch session, but I'm going to give this a go. So hopefully you'll have some questions, and we can make this just a little bit interactive. And I think it'll just make it a little more valuable if we get a little bit of sharing of experience on some of these things. So what we're going to focus on is internal control breakdowns and how they affect the integrity of financial reporting, and also we've got a few in here that really touch on revenues and kind of go hand in hand with, I think, the fiduciary responsibility for ensuring that you're collecting what you should be and you're aware of your income earning assets. So I guess just kind of the basics here. Does everyone know what COSO is? Does anybody remember what COSO stands for? It's not very intuitive. I had to write it down. The Committee of Sponsoring Organizations. So that's a real nice clue as to what they do. But they do have a good definition of internal control, a process affected by an entity's board of directors, management, and other personnel, designed to provide reasonable assurance of the achievement of objectives in the following categories: effectiveness and efficiency of operations, reliability of financial reporting, compliance with applicable laws and regulations. And I think this is a really overlooked thing in a lot of agencies. I started in banking, where everything you do is about, the control of the cash, internal controls, procedures, dual custody. Somebody leaves, they change the locks on the door. When's the last time your agency changed the locks on the doors? How many keys are floating around somewhere? And so early in my career, I just got exposure to all these things. And as I started, and if anybody worked in retail, and you understand how cash registers work and some of the procedures for cash and closing drawers. And then you go to a municipal tennis court or pool house, and you see the way they keep track of cash. It's just a world of difference. And so part of this is having an understanding from the city manager point of view and the council or board point of view that there are financial consequences to internal control breakdowns. That does reflect on management and finance, because really you as finance people and the city manager as the executive management and the overseeing governance, whether that's a board or a council, are responsible for internal controls. And I can just tell when I say internal controls, when I see the eyes glaze over, I just know they have no frame of reference. They know the word internal and they know the word control, and they think they can somehow derive it, but they have no real life experience of what that means. And again, if you worked in Treasury or you worked in these places where everything you do is built around it, you kind of develop a sense of it. But a lot of that gets lost along the way. I noticed whenever there's a downsizing of a finance department or staff, how many times we're going to lose an internal control feature here if you get rid of this position. How many times does that get discussed, right? It doesn't, because usually the layoff procedure is based on something already prescribed that has no relationship to the business of the organization and certainly not to internal control. So I've got, I think, about 9 examples here, and the way I thought we could do this is, I'll give you my little anecdote of what kind of inspired this as being one of the breakdowns that I wanted to talk about. If anybody can top my story or has a better one, I'd like to hear it. And then talk a little bit about what you can do or what you could do to avoid these kind of situations. The first one comes from when I worked in a savings bank, and one of the loan agents diverted $50,000 over a period of several months. He was basically collecting checks from people seeking home loans to reimburse for the appraisal. So we hired an appraisal company that ran out and did all the appraisals. He was collecting these checks, $150 here, $200 there, directly from the customers to reimburse the savings bank for the appraisals. And basically what he wound up doing was the check was made out to the bank. He put the bank's name in parentheses, wrote his name above the pay to, and went and cashed the checks himself at our own branch, at the main branch headquarters. And so once he started doing it, it was like the tellers were used to seeing him. They cashed these checks, deposited them into his account. The controller was looking at analyzing the revenues one day and was wondering what happened to the reimbursements for appraisals, what happened to the appraisal income. And started digging into it, and it wasn't very hard to find the trail once she was onto it, that he'd basically been embezzling these funds, again, to where it got to just under $50,000. And so aside from kind of the embarrassing aspect of he was doing it right, probably less than 100 feet away from where the controller's office was as he was going into the bank every day to deposit these checks, it brings to mind she would not have known this if she hadn't been analyzing the revenues and really tuned in. And so when you think about all of the revenues that flow through your agency, is somebody looking at those in a way, whether it's a variance analysis or a check, is there really accountability across all revenues so that if this were to happen, you would catch it, at least in a reasonable period of time. So the consequences, embezzlement, missed billings. If you don't know what assets are investment earning or revenue earning assets, when you do a review of your receivables, when you do a review of your billing, you wouldn't know if something was missing. I think the thing that winds up happening a lot is annual billings, right? Where somebody pays rent on something or there's a lease with an annual payment. If that's not set up rigorously with a system that's going to remind the person and you can have turnover and not counting on somebody's memory to remember to bill, those can easily get lost in the shuffle. And so, do you have an inventory of those things where if you were training somebody or if you were transferring your billing onto a new system, would you even know what you were transferring across the board? Or are these things, spread out across the organization? Which brings up another issue. Do you allow other departments to generate invoices independently on your letterhead? I can see from some faces. This is good because if you're bored here, it means you've got a really good, well-run operation and this doesn't really mean anything to you. But if you're starting to think about these things, that's really the purpose of this, because if somebody can, go on their computer, generate an invoice, off your organization's letterhead, direct the payment to them. If that's allowable for them to even generate an invoice off a system, then that's a problem, because it means that you really don't have control over your invoicing. payments that can be directed outside of finance or outside a controlled environment are subject to embezzlement and manipulation. And so whether that's some kind of code enforcement fines or ad hoc billing, there has to be a really good reason for a department to, outside of finance, to independently generate an invoice. I mean, they may generate a reimbursement request on a grant or something through a system, but for them to really, for anybody outside of finance to be able to generate an invoice, it ought to be under a controlled environment where they're doing it on the same system, where they're doing it under good controls and for good reason. And I guess, so just kind of leaving you with that question, you know, would you know if somebody were intercepting payments? Would payments be missed? Or if revenues were not being collected? And is it okay to have a check come in to another part of your organization outside of a central accounts receivable structure? The second example of an internal control breakdown, an accountant in one city I worked with noticed a dramatic increase in the accounts receivable that was associated with the class registration system that was basically used for recreation programs and facility rentals. And there was no business reason why the accounts receivable should be growing over a period of a couple or a few years. And as we dug into it, we found that the receivables really should not have been growing. Fortunately, it wasn't an embezzlement situation, although it took quite a while to look into it to really be able to say categorically it was not an embezzlement type situation. It wound up being a situation of overstating revenues for a period of time. So they had to be written off to the tune, it was a six-figure kind of number, about $100,000 had to be written off. This accumulated over several years, so it wasn't just a temporary glitch or something that was just a lapse for a short period of time, but actually accumulated. And so this gets into the general category, which I characterize as control over subsystems. How many different ways do people cause transactions to enter your general ledger? And I think more and more with now you've got these point of sales where through all kinds of different mechanisms you can receive donations online, or you can have I know we get hit where all of a sudden money comes in, we can't figure out where it came from, and we have to trace it down. And then that winds up having to be represented somewhere, usually after a lot of research to figure out what the source was. So you've got a couple issues. One is do you know what money do you have control over all the money coming in terms of, is it really expected, or do you have people generating transactions where they're sending money into your system and you're not sure where it came from or why it's there? But back more to the subsystem issue, you've got everything from recreation programs, facility rentals, business license, building permits, planning fees, utility billing, miscellaneous billing, even payroll will generate activities, right, with payroll clearing accounts and deductions that affect your balance sheet. And so I guess the more I look into this, the more I see there are usually holes in one or more of these systems where there isn't somebody who's really reconciling these things and doing the kind of balance sheet analysis to check the receivables, to check the deferred income, to make sure that this is correct across the board. And I think when you have, maybe in large organizations, you can have ownership within the actual areas, like you can have somebody in utility billing actually responsible for balancing to the general ledger and reporting out when there's issues. I think often it falls to the accounting side because particularly in areas that don't necessarily have people that are really, you can't even say the word reconciliation to them because they don't really know what it means and wouldn't know where to begin. And so if you've got rich accounting staff and you can assign people to follow up on all these things, you can compensate for that. But my experience is the ability to generate transactions faster than you can reconcile them. I think we passed that mark long ago in terms of just you've got so many points of sale, so many points of entry into your cash receipts, into your system, that to really be able to look at an accounts receivable and trace it back to, what does this really mean in terms of aging, or deposits is another big one, because deposits go in, finance doesn't know when they're supposed to go out or whether they're legitimate or not. You wake up one day and you can't really account for what you're showing on deposit on your balance sheet. So does anybody have any examples or questions or anything to add to this one? I know it's got to be a big issue. Somebody. Okay. But I think the challenge is, first of all, inventory all the different ways things come into your system, and just ask yourself, how do you know that these numbers are correct? What are you even running reports, or have you even verified that they're reports that could be true points of reconciliation? So my third example, and then just backing up to that, there really should be somebody accountable for each module. And if you wait till fiscal year end to do this as part of a year-end procedure, it's usually overwhelming because you've got 12 months of research, or maybe more if you find a problem that went back a number of years. The balance sheet analysis really needs to be ongoing, and the reconciliation really needs to be ongoing. Whether that's ensuring that your payroll clearing accounts really are clearing. I'll give you one example that I challenge anybody on. Unless you're in a sleepy district and you've got so much time on your hands, you actually go and do this. I've never seen anybody really do this, but on the flexible spending accounts, right? Particularly on the medical side, because there's a little more control on the child care side, because you can only take out what you put in, and you can't take it out until you put it in, right? But on the medical side, you can sign up for $2,500, $2,600, whatever, and then you can have a medical procedure, draw down on it right away in January or February. Then you can leave the organization in April, and you've put in less than what you've taken out. And so basically, in terms of that in-out clearing, there's a deficit. Then you have the other side, right, where somebody sets aside money and then they forget about it, and then they don't have enough medical receipts at the end of the year, and so they leave money on the table. So those two examples, or someone just can't be bothered to file. So now you've got more money coming in on some people than going out, and more money going out on some people than coming in. So you're going to have a residual every year based on those dynamics. And so if you clear those and account for those, then you're at least managing it, looking at it, making sure that things are correct, because I've run across where X number of dollars is being deducted every 2 weeks from somebody's paycheck for a flexible spending account, but the third-party administrator, because usually you use third-party administrators, so you're not doing these reimbursements through accounts payable, thinks that they have a different amount deducted. And so is anybody really looking at that? And I guarantee you most HR departments aren't looking at that. So just the payroll clearing accounts and payroll type accounts themselves wind up accumulating things that just don't get better with age. They just keep accumulating over time. And then you'll be in a position where you can't explain any of it. It's just a number that's accumulated over years. This kind of goes to something that if you worked in retail and cash registers, you kind of know how this works. But I haven't seen much in the way of sophistication in a lot of agencies. But a retail shop lost nearly $100,000 to embezzlement because what employees did was they closed the cash register early. Say they had another few hours to go. So they closed the cash register, cleared it out, balanced based on that. Then the subsequent transactions, they just pocketed as if they weren't there, and cleared out at the end of the night. And basically, this wasn't picked up on because the oversight wasn't sensitive to just the common ordinary functions in cash registers. I'm not going to go into the whole thing now, but you can look up Z reports and X reports. But they're basically tracking mechanisms where you can see from the register tapes where there's a lack of continuity, right? Where there's a gap. And so if somebody had been monitoring those reports and sensitive to what's being run through the register in total, they wouldn't have just bought the cutoff reports that cut off mid-shift and created the opening for the embezzlement. And they would have discovered the issue much sooner. So, and again, my experience in most recreation departments is they don't have sophisticated cash registers. They don't have the kind of procedures for balancing and review of these tapes. Often it's just, sometimes it's even money in unlocked boxes that's just kind of there for the grabs. Not a lot of dual custody or dual control on cash. So, and not a lot of training around cash handling, which is a whole other issue. You know, of all the people that touch cash in your organization, how many have had any kind of cash training? And, you know, it kind of takes me back to the banking days of, you know, you don't turn a teller loose without cash handling training. It's just part of the training, part of the initiation, part of what they do. In retail, you give people some kind of cash handling training and procedures and guidelines. You know, at a recreation tennis court or swimming pool, what kind of training do the people have that are handling cash? And are they providing receipts to the customers, or are they tossing the receipts and pocketing the cash? So it's a whole area of vulnerability. I think the other vulnerability is, you know, cash is really sensitive. When you have cash losses, it's a big deal, and it just shows a lapse in ability to control what is your responsibility to control. And I think it's, I mean, the question I'll leave you with is, you know, to the extent that there is missing cash, you know, would you even know there's missing cash through your procedures? And do you ever test it? Do you ever go out and observe how cash is being handled at a tennis court or a golf course or a swimming pool, or any of the remote sites that handle cash but don't really have the kind of infrastructure that you would have in a true retail site? Number 4. I'm not going to go into crazy detail on this because some of this I think was covered earlier today in terms of the technical basics of this, but large school district lost control over its $300 million decentralized grants management process, and I think that's redundant because there's almost no way to centralize a grants process. You've got fire applying for grants and police applying for grants, public works. And, you know, I think in a better system, you hear about it earlier and you have input into at least the viability of and the infrastructure to hold up your end of the grant requirements. But a lot of these, you know, they're engaged in with the excitement of, oh, we have money here, oh, we can get money there. and not much discussion about what kind of burden are we taking on, who's going to manage it, is there going to be real accountability? And even in the firms that specialize in grant management, there's like this cultural divide between the program managers and the financial types that are responsible for the accounting and reporting. And so, and yet the consequence of error is huge in terms of lost funding, just the kind of things you have to do nowadays to explain what you're going to do to remedy findings, the compliance audits that follow that to verify that you remedied the findings. And it winds up being one of those preventable types of things or embarrassing things to explain because, you know, why didn't you know the number of the grant? Or why, you know, the agreement said this, why didn't you follow it? And again, a lot of it's basic in terms of program managers not really being fully accountable. People wind up being in charge of programs not really well trained to manage them and not well versed. And when you're on the learning curve on these types of things, it's very difficult to ensure the quality. Finance will call the people looking for information and they have no idea what they're you know, what's being asked of them because they're not really familiar with the program that they're running. And so I guess I'll just say, yeah, two things on this, because I haven't seen an organization really successfully, unless they're large enough to have a true grant manager that's a true clearinghouse for all grants. I haven't really seen agencies, you know, be successful in centralizing when they're small. But if you can coordinate in a way where there's enough communication with the people that are initiating grants so you can keep up on the status so you don't get blindsided. I think the other issue is when they do need you, when they do come to you because they need to set up a budget or they need an account or they need a project tracking, that's the time to establish, okay, have we got a checklist here? Do we understand the nature of this grant? And are we setting things up for proper reporting and compliance? But you've got to get it before the transactions start moving through, and they've got account numbers to charge to, and then they're kind of on their merry way. This next one is a little different. Here's example is the city neglected to review how benefits were being represented on the payroll system. They performed a very limited review of W-2s and then later discovered that there were significant errors in the reporting of taxable income for certain medical premium allowances. Group term life wasn't being calculated properly for tax purposes. Take-home auto vehicles weren't reported properly. And health club reimbursements, which are taxable, were completely off the radar. In fact, when I say off the radar, it wasn't, these benefits weren't even documented in the MOU. They were just routinely provided on a reimbursement basis with no connection to documented benefits in the labor contracts. And no real understanding that notwithstanding the fact that it's in the general category of promoting health, health club memberships are a taxable benefit. And so the thing that comes to mind on this, for those of you who remember what W-2s looked like in the 1980s, I think there were about 6 boxes filled up, right? They're like, you know, it was basically about your income and it was about your taxable, you know, tax deductions, you know, your FICA, and then it was about your withholdings. So, you know, it was very simple, you know, like I said, it seemed like 6 boxes and you're done. And somewhere in the last 3 decades, it's gotten a lot more complicated, particularly in the area of benefits. Now there's more benefits reporting going on a W-2 than there is earned income type activity and tax deductions being reported. You've got a whole array of codes, and each code, each box has its own, unique kind of requirements and in terms of fulfilling the reporting. So if when you set up the benefits administration, you don't take this into account, and there's not good, strong communication and coordination between kind of the HR function of benefits administration and then the payroll last stop on the way to W-2 reporting, there is a lot that can go wrong. And aside from the simple issues of are you really offering all the benefits consistent with the way they're described in the MOUs and that type of alignment, once you are offering a program, let's just say the life insurance premiums, are they being offered correctly? Are you accounting for them correctly? Are those tables up to date and being applied properly in terms of how the IRS requires that you value the life insurance in excess of $50,000? And are you reviewing those in a way that, if you get off track and it's wrong one year, will you be able to see that and correct that the next year, or is it just an ongoing problem in the way you report? And this particular agency had to, it was bad enough that basically had to generate about 300 corrected W-2s covering 2 different years. And that's 8 941, I guess 941Xs. And it was very disruptive for employees to have to go back and refile returns. And again, small errors are forgiving. If you've got good momentum and you're on top of things, you can usually correct things as you go. But if you accumulate errors to the point that the only way to fix it is to go back 3 years and restate W-2s and disrupt your workforce with filings, and then you get other crazy things going on, like, a given employee was married 2 years ago but isn't married now and now has to go back and deal with refiling a tax return. They really can be disruptive, and it's worth proactively addressing it. I don't know, how many people in here have been through an IRS audit? Did any lead to having to go back and restate anything, or was it just you're able to correct going forward? Going forward? Okay. I can assure you, if this agency had gone through an IRS audit, it would not have, it was not at the level where it could just go forward and correct. There was just enough dollars misstated that there's no choice but to go back. I guess the other thing I'll point out on the health club reimbursements, whenever a benefit's offered, I think one of the disconnects is people designing benefit programs or coming up with benefit ideas don't always know the tax law, don't always get good advice on the tax law. And actually the same thing goes for the bonuses and gift cards and things people like to give out. I think most people in here aren't surprised that there's no de minimis on cash, and gift cards are considered cash. And how many of your departments go out and buy gift cards for, hey, good job, Sally, and in creating these kind of issues that that they really need to be educated on. Same thing goes for the take-home vehicles. Because that's one that's kind of changed over time, right? If you go back to the 80s, you could have a take-home vehicle, great, nobody's keeping track of your mileage, no one cares how many miles you commute in or whose gas you use, or there's just not a whole lot of accounting or attention on that. And the problem is some of those people with take-home vehicles remember that because they were, they started their employment in the 80s, and then They get bent out of shape when you have to tell them, well, I'm sorry, but you're not in an exempt vehicle, which is, by the way, that's another definition that's narrowed over time. And just slapping a city seal or agency seal on a sedan doesn't make it an emergency response vehicle. And carrying around a flashlight or a red light or something in your trunk doesn't automatically do it. There are, very narrowly defined situations where a take-home vehicle is exempt for the commute mileage. And the other dynamic, since I think that is worth a little bit of time, I'll give a plug for Maze. We retained Maze to write a letter to us, basically explaining the law around take-home vehicles, the IRS interpretation, because they wouldn't take it from the finance department that, hey, you have to report this. We got it in writing so we could take it to the city management and say, look, the take-home vehicle policy has to change. We have to comply with the reporting requirements. We don't want an audit, IRS audit, to trigger having to go back and report past year value of commute miles, which are always personal, for the employees who are driving these vehicles. And even the police vehicles, because of the way the policy was written, giving them access to use the vehicles for personal use anytime, any place, was out of alignment with the IRS requirements for the true public safety vehicles. So, so one question is, do you have an inventory? Do you know everybody in your organization who's been assigned a take-home vehicle? Just start there. If you don't know who has a take-home vehicle, then you don't really even know where to start in terms of evaluating, okay, what kind of vehicle do they have? Is that a vehicle that is truly exempt or not? Then if you get to, okay, they have a vehicle, it's not exempt, okay, are you tracking the value of the vehicle for the purposes of evaluation, the business miles versus commute miles? And then there's one other facet of this that starts to become a little more of a political issue, and that's when you look at the nature of our business, right? It's local, right? So when we do business, it's all running around town, driving around town. It's not like, your sales rep who's putting, 200,000 miles a year on a car, driving to clients and trying to make sales. And so when you measure the commute miles that somebody might have, let's just say they don't even live that far from the agency, maybe 25, 30 miles. So they're racking up 60 miles a day in personal time or personal mileage on their commute. How many miles are they putting on the vehicle doing city business or agency business? How far can they go on city business when you're talking about the kind of short trips that you typically make with these vehicles? And so you wind up with a situation where 80 or 90% of the use of the vehicle is personal. And so then you ask yourself, why is this in the fleet? If it's only being used 10 or 15% of the time for agency business, what's really justifying it even being maintained in the fleet? So I think that's a big issue because whenever this actually happened north of here, where I think it was a sheriff was off duty, was in an accident, not his fault. It was like, I think it was a drunk driver hit his car, but he was driving the sheriff vehicle. He was on vacation, he was with his wife, and so, the issue becomes, okay, so this accident wasn't his fault, but it was damage to this county vehicle that he's using, to drive to a vacation spot. And that's where I think it starts to get, on the political side of not just are you accounting for this properly, but does it make sense for people to be able to use the vehicles, even though they theoretically could be responding to an incident when they're on vacation. So I think that's a big one, and I think it's worth worth ensuring that you at least know who's got the take-home vehicles and that somebody's collecting the information that you can use to report accurately. Anybody have any questions or comments on that? None. Everyone's stunned or... Okay, you're either bored because you got a complete handle on it, you're scared, and so you're afraid to say anything, or you're somewhere in the middle and taking this in. But I'm just curious where people fall. An agency not too far from here, a special district, lost thousands of dollars worth of tools and materials that were purchased with the district's purchasing card at Home Depot, but were dropped off at an employee's home prior to returning to the job site. So the idea here, right? I mean, I call them purchasing cards to emphasize that it's a purchasing vehicle. It's not really credit as such. I think credit card sounds like, oh, there's this extension of credit going on, and the agency's putting things on time as opposed to it's a purchasing vehicle, but it's the way of doing business, right? And so all the maintenance people have access, and you have a lot of purchase points out there in most organizations that are running around with these cards so that they can buy something from Napa Auto Parts or Home Depot or whatever. And so the question is, what kind of review process do you have in terms of oversight for these purchases? Because in this case, you've got people running around with the cards, buying things that may be legitimately used on a job site or for the agency's business, but also could be used other places for personal use. And do they really make it to the intended place? And I think here it's important that, and this is an educational type thing, first of all, do you have a second signature on all purchasing cards in terms of oversight, so that there's at least a dual sign-off? But just as important, is it a rubber stamp, or is it somebody who actually knows enough about what the person that they're overseeing is doing to know when something might be out of place? It's like, how many shovels do you need for this job? And who can give a real reasonableness kind of oversight to it, to really make it a valid source of oversight. And so the person has to be knowledgeable of the purchase rationale. They can't just be a rubber stamp. And if you do have a purchasing policy, it should require periodic audits and checks. And if you're not doing those, that's just another, again, over time, if it's never looked at, it becomes a growing liability and opportunity for abuse. And those tend to be pretty embarrassing when they hit the press. Let's see. This next one, how are we doing for time? All right. We're on the home stretch. This category is consultants and intermediaries, and the importance of reviewing work of those on whom the agency relies for revenue compliance. Another agency lost hundreds of thousands of dollars by relying on records maintained by the county that was used for special tax assessments collected through the tax rolls. And so the issue here is it's very risky to consistently rely on the work of outside parties, even experts, without at least a periodic verification, validation of their work product, because you're ultimately responsible for what happens with that work product. And so first example is continuing disclosure. And this is another one of those that it's really hard to explain why you don't comply with your bond covenants because, hey, they're there, you know, agency promised these things. Of course, when they're issuing bonds, everyone's thinking about the project, right? Not about the compliance aspect of the continuing disclosure and the things that follow. And then, you know, you move from one agency to another, well, now you've inherited all of the bond disclosure requirements, bond covenants from all of the issues that that agency did. And I'm sure your first week on the job, you don't break out all the bond documents and start pouring through them looking for what this agency's agreed to. But, and of course, all bond documents are different depending on who prepared them, and they're all written a little differently in terms of the kind of promises made with respect to disclosure. And, you know, this is one that, you know, there are a couple groups out there that provide support on this continuing disclosure, but I know they miss things. I mean, it's so easy if you have an insured issue and there's a slight change in the rating of the insurer, and you've got 10 days to provide the disclosure. You know, it's easy to miss. And so I think you have a combination of things. You've got differing requirements on differing bond issues. You've got a tight, you know, 10 business day commitment or expectation of providing disclosure on relevant changes. And nobody's really guaranteeing that they can track any of this in a way to keep you 100% compliant. And then if you don't comply, and then when you issue new bonds, you say you're fully compliant, well, now you just misrepresented the fact that you're not fully compliant, and you have another kind of disclosure issue. So it's, and whether you issue often or not so often, I think it's a bit of a dilemma, because if you issue often, you've got a lot to keep track of. If you issue not so often, you probably don't have a lot of infrastructure and time dedicated to this area. So either way, which is why we rely on outside parties to help monitor these things, which again is helpful, but you just can't run it on automatic pilot, not verifying what they're doing. The second one is, talked about this with the flexible spending accounts, but third-party administrators often used for workers' compensation and general liability. And what do they usually have access to that might be pretty sensitive? Right? Your bank account, right? I think in a lot of these structures that I've seen, they're paying claims, you know, out of, maybe it's a zero balance account or a special account that they're asking you to transfer funds into. And so in effect, and you may have some requirements where you sign, you know, above a certain limit, but at least for the smaller claims they're paying, they're basically writing checks out of your account. And, you know, the question is, if they make a mistake and pay a workers' comp claim from some other agency out of your account, or they double up and issue 2 payments where it should have been 1, you know, is somebody reviewing their activity in a way where you would even notice that? On the workers' comp side, it's usually a pretty high volume, right? With checks to doctors and checks to employees, also former employees whose names you might not even recognize because they're from 20, 25 years ago. So difficult for one person to really just be able to glance at it and know, oh, this looks right, or it doesn't. But the first question is it being reviewed at all? And do you have enough confidence that the standard of review is enough that you would know if there were problems? particularly on the workers' comp side, but it can happen on the general liability side too. The county assessor, just seen this a number of times where, for convenience and for security, you're running, your agency's collections of special taxes, sometimes certain fees through the county for the reliability, and if you're not set up to do the billing yourself and don't want to get into an unsecured situation, it's the best way to do a lot of collections. But the county assessors are performing this function, but they're not taking any responsibility for the accuracy of your agency's information. And I think where their focus, their quality control focus, is on the things that affect the revenues that they generate for themselves. The things they provide as a service or a convenience, they're just not taking responsibility for. And so just because they're the county and they have the records, doesn't mean you can automatically rely on them, particularly when you've got provisions in you might have a parcel tax and you've got provisions that don't necessarily match up with things that the county really rigorously maintains and follows. You've got to make sure those things are in place. And again, it's an area where consultants are used to assist with that, but you really need a reliable way to convince yourself that that's being done properly. And whether you're use an RFP process and a changeover in consultants to kind of help put more light on it, or or bring in somebody to look at from time to time what you're doing in those areas. Again, some are simple, but there seem to be more and more complex mechanisms out there, because people get pretty nuanced when they develop these parcel taxes and special taxes that are not just plug and play for the county, that you can just expect that it's going to be easy and not require follow-up work. The report preparation, state controllers reports, streets report, that's another one that smaller agencies rely on somebody to come in and assist them with the report preparation. But again, if you're signing the reports, you've got to do something from time to time to really verify that these are being prepared properly for you. Because even if you have the best of contractual terms, where there are penalties if they provide you with bad reports or bad information, that's not going to help you explain or why the report's bad when you have to explain it to your board or council, because again, everything you sign is really reflection of your office, and the reliance on somebody else doesn't get you off the hook for that. Another big area is the rate consultants, and I know there have been lawsuits where cities have sued their rate consultants for lapses and things that they determined later or decided were mistakes that resulted in missed revenues. But it's the same issue. You can bring them in for their expertise and for their models, but you can't over-rely on the results without good reason and without good steps to ensure that you're just not taking the results at face value. So the reason I think these are important is, with limited staff, there's just a greater tendency to try to farm stuff out, contract things out. It can be efficient. It can be much better than trying to recruit and train people in-house to do these things, because they are complex, they are difficult, but somebody still has to be managing the contracts and the outside people. The district tax administration, kind of covered that. Let's see. Oh, one more. Benefit design. You know, whether it's health plans or retirement programs, you know, I've run across, actually recently saw an organization that had to kill off a 401A plan because they were administering it incorrectly. They had cash out provisions and options that aren't allowable with 401A plans. And I don't know who they got their advice from in terms of the setup of the plan, but they either got good advice and didn't follow it, or bad advice and they did follow it. But it was a big ordeal to kill off this old plan and go back to the council and have to undo what they did because it just was not a compliant plan. And that's something where at the point of benefits design, and some of this goes into the taxable nature of certain benefits and how they need to be reported. You really have to make sure you're getting good advice in terms of that as the benefits are designed, and that really does inform the final benefit design, because if you're the one that's going to wind up having to deal with the W-2 reporting, other compliance issues that come down the road, you know, working with HR when these benefits are being negotiated or when benefits are changing, to make sure that first of all, that the advice you're getting is good, and that if it is good, that you're following it. Yeah, so again, you can delegate the work, you can delegate the tasks, you can't transfer the responsibility, and it's kind of that tough one, that catch-22, because the reason you have people on the outside doing this is because you don't have people on the inside with the capacity to do it, and yet somebody has to verify and validate what they're doing. Control over refunds. This is really the other side of the subsystems issue. If you have control over your deposits, if you have control over the revenues, you know, what do you also have control over the refunds that are issued? You know, and the trouble with these are, you know, you probably have some quick vendor, easy vendor way of writing a check to somebody without having to go through the same kind of process you do when you're when you bring somebody in under a contract and they're going to be set up as a full-fledged vendor. And is the, you know, do you require internally that two people who really understand what's, and can validate the veracity of the refund in the mix? Or is it just one person saying, here's a list of refunds, you know, these people are on the list, and then the approver, you know, wouldn't know if those people really made deposits or really are due refunds, but is just kind of a simple sign-off where you've really just allowed one person to direct refunds to anybody they want to if you're not going through that validation process. And it can just be an easy, you know, way if you don't have good controls, because somebody sees, oh yeah, this is how easy it is to get a refund check. You just fill out this form and you say, make it out to so-and-so, and the agency does it. So without a good check on, because there's no real physical inventory you're tracking, right? If somebody, you know, is deserving of a refund on business license, it's not like it shows up in an inventory count that's physical. It's, you know, it's documented in a way that is a little trickier to get to. But the point is, you know, if you don't have adequate controls, you've got a real vulnerability there. Last one, contract authority, monitoring contract not to exceeds. You know, just the issue I see here is there's not often a good definition of thresholds where, you know, you can say, okay, any contract over, you know, $30,000 has to go to the council. But what does that really mean? When is it a contract? What happens if one part of the organization is using a vendor for one reason and another is using it for some similar reason but not exactly the same? Are those two contracts or is it really one? And so in the absence of good definitions, I think you have to at least make sure that the basics are covered, where if you do have an authorized not to exceed, that there's a mechanism in place to enforce that. And if you're using the purchase order process to do that, that's great for the items where they're purchase orders. But a lot of things sneak in, broker relationships and other things sneak in that aren't on purchase orders because they don't lend themselves to purchase orders. But we don't have a whole lot of time to dig into that. I'll just end with the challenges here. Internal controls are not well understood. They're not a priority until something bad happens. And I was looking at this morning, and I actually don't believe that. It still isn't a priority after bad things happen in some places, because, and here's why. Because it's like, okay, something bad happens, and rather than diagnose it as, oh, this is a problem of not having sufficient internal controls, this is an internal control lapse, it's diagnosed as, oh, well, problems happen, this is, just an isolated thing. And so they don't address the issue of internal controls. So even when something bad happens, if it's not properly diagnosed as an internal control lapse, then you're not going to address it and correct it properly. You're just going to go on and wait until the next thing happens. And as I mentioned before, it's not generally considered when resources are being allocated and reduced. So you've got to document issues, note the consequences, make resolving internal control issues a part of your work plan. That at least gives it some visibility. Educate city manager or general manager and council or board on their roles in internal control. If you have a finance committee, maybe you can get some leverage through that. If you have audit comments, maybe you can get some leverage through that. And ensure that internal controls are part of the criteria used when business processes are evaluated. So, I know we're out of time. One question? Is there one question out there? Okay. How many were bored? How many are panicked? So everybody else is somewhere in the middle. Okay. Thank you.